Imagine this. It's the peak of summer, right? Sun's just relentless, and your air conditioning unit suddenly sputters and dies. Silence.
Yeah.
Or maybe it's the dead of winter, freezing cold outside, and your furnace just quits.
Ugh, the worst.
Exactly. You're in a bind, so you pick up the phone, you call an HVAC contractor, and after what feels like forever, but hopefully is just hours or maybe a day, they show up.
Right.
They diagnose the problem, they replace a part, maybe even the whole system, and poof, comfort restored. But wait a second. Pause and think about it. Who supplies them? Who's the invisible backbone providing all that equipment? Every little component, the tools, the refrigerants, everything that makes that fast repair possible.
That's the million-dollar question, isn't it?
It is. And today, we're doing exactly that. We're pulling back the curtain on this unseen essential. We're going deep into a company that really touches almost every home and business, yet most people haven't heard of them. Watsco Inc. That's WATSCO. They are the undisputed leader, the most technologically advanced distributor of heating, ventilation, air conditioning, and refrigeration HVACR products in North America.
And you've really hit on something crucial there. Watsco isn't just, another company. It's a critical intermediary. It's strategically positioned right in the middle of this market that's not only massive and incredibly fragmented,
Right?
but also fundamentally non-discretionary. I mean, when your heat or AC breaks, fixing it isn't usually optional, is it?
Definitely not.
Watsco basically capitalizes on that essential need. The connective tissue ensuring homes and businesses stay comfortable all year round.
So our mission today, then, is to give you a shortcut. Instead of you having to wade through, dozens of dense investment reports, complicated SEC filings, scattered industry updates.
Which is a lot of work.
It is. We're going to extract the most important nuggets, the key insights. We want you to walk away from this deep dive really feeling like you get this quiet giant. We're going to unravel Watsco's very unique buy-and-build growth strategy. It's a philosophy that's really shaped their dominance. We'll explore their competitive advantages, their moat, especially how they use technology. People talk about their digital moat.
Yeah, that's a big piece.
We'll also look at how they're navigating these huge industry shifts, like the upcoming A2L refrigerant transition.
Massive.
And ultimately figure out what makes Watsco such a remarkably resilient and, frankly, enduring business.
Yeah, this deep dive, it should uncover some surprising facts, some critical insights.
Yeah.
You'll get a really clear picture of how this, behind-the-scenes company operates, why its strategy matters, and how it keeps delivering value year after year, even when things get turbulent.
Okay, let's unpack this. Let's dive into the world of Watsco. So let's get right to the heart of it. In an age where everyone's pushing direct-to-consumer, why does a company like Watsco, an intermediary, not just survive, but actually thrive?
That's a great question.
Why can't these big manufacturers, Carrier, Rheem, just sell their stuff straight to the local HVAC contractors installing it? It seems like an extra layer.
It seems like it, but that question gets right to Watsco's core value. They're not just an extra step, they're an indispensable hub. And here's why. They solve incredibly complex problems, logistical, financial, informational, for both the manufacturers and the contractors.
Okay.
Think about it. HVACR systems aren't simple things like toasters. You've got the main equipment from, say, 20 major OEMs, the Carriers, Rheems, Daikin's you mentioned.
Right, the big names.
But then to make those systems actually work, you need thousands, literally thousands, of smaller specialized parts, components, supplies. And these often come from another, 1,500 plus different vendors?
Wow, 1,500.
Yeah, it's a huge number. Now imagine you're a typical local HVAC contractor. Watsco serves over 130,000 of these active contractors and dealers. Many are small businesses.
Right, the local buys.
Exactly. They just don't have the buying power to order in bulk from 20 different OEMs. They don't have the warehouse space, the logistics, the staff to manage relationships and inventory from literally thousands of individual parts suppliers. It'd be chaos.
Okay, I see.
Watsco consolidates all of that. They buy at massive scale, they manage these huge, complex inventories, and they provide a single, reliable, local source for everything a contractor needs, from a full AC unit down to the tiniest specific capacitor.
So it cuts down lead times, makes life easier?
Massively. Reduces headaches, lets contractors focus on installations and service, not sourcing parts.
So it's really about centralizing this incredibly fragmented, almost bewildering supply chain. Without Watsco, or someone like them, the small local contractor would be spending half their time just trying to find parts, negotiate prices, manage vendors.
Instead of fixing ACs.
Exactly. Watsco basically makes that whole logistical nightmare disappear for their customers, allows them to just do their job. Now let's break down the revenue. It's not just the big units, right? What are the main categories?
You're right. It's diverse, and that's a key strength. Looking at 2024 gives a good picture. The biggest slice, about 69% of revenues, is HVAC equipment.
Okay, the air conditioners, furnaces.
Exactly. Residential, commercial systems, heat pumps, the big-ticket items. But this segment typically has lower gross margins. It's competitive.
Got it. What's next?
Then you have other HVAC products. This is about 27% of revenue in 2024. And this category is really interesting from a profit standpoint
Why is that?
because it includes all those higher margin replacement parts, components, supplies, accessories, everything from compressors and motors to thermostats, ductwork, refrigerants, even the tools contractors use.
Stuff from those 1,500 plus vendors.
Precisely. The sheer breadth here, being a true one-stop shop, is a huge differentiator. It makes them indispensable.
Okay, so equipment, other products. What's the last piece?
The final bit, around 4% of revenues, is commercial refrigeration products. This is more specialized, condensing units for freezers, walk-in coolers for restaurants, ice machines, that sort of thing. But what's really insightful, is how this diversification works. Especially those higher margin other products, they perfectly complement the big equipment sales.
Ah, so they balance out the lower margins on the big units.
Exactly. It provides resilience, boosts overall profitability. It creates a whole ecosystem for the contractor.
And a huge part of that ecosystem you mentioned is the focus on the replacement market. This isn't just about new houses getting built.
Absolutely. This is probably one of the most critical things to understand about Watsco's stability. Somewhere between 65% and 70% of their revenue comes directly from replacing existing units.
65 to 70%.
Oh, yeah. Compare that to new construction that's only about 10 to 15% of their sales. Much smaller.
And why does that matter so much for resilience?
Because replacing a broken heater or air conditioner is usually a non-discretionary purchase.
Right. Oh, yeah. If it breaks, you fix it fast.
Exactly. If your AC dies in Florida in August, or your heat goes out in Michigan in January, you're not waiting for the economy to get better. You need it fixed now.
Comfort isn't optional.
Precisely. So this creates this steady, stable, less cyclical demand stream. It makes Watsco's core business much less vulnerable to economic downturns or the ups and downs of the new housing market. Their business is built on essential needs.
So that heat wave scenario, the AC dying, that immediate, non-negotiable need for a fix that's the heart of Watsco's business, explains their robustness. But they're not just sitting back waiting for things to break, right? How do they actively grow this empire? And here's where it gets really interesting, I think. They have this specific growth strategy they call the buy and build philosophy. What's different about that? It sounds like more than just M&A.
It absolutely is.
Yeah.
And this buy and build idea is really central to their long-term success story. The buy part is, yes, a very disciplined M&A strategy. Since 1989, they've bought and integrated over 70 businesses. They target good, well-run regional distributors. The goal is either expanding their geographic footprint into new areas or increasing their network density in markets where they already are, especially high-growth ones. It's a very systematic way to add scale and local strength.
Right, the M&A piece. But what's the build part? That sounds like the differentiator.
It really is. This is what sets Watsco apart from just a typical roll-up. Instead of just swallowing these companies whole and making them blend in,
Yeah.
Watsco keeps a very decentralized approach. They often retain the local management teams, the existing sales force, even the historical trade names of the companies they buy.
Why do they do that? It
Yeah.
seems counterintuitive.
Because those local relationships, that community trust, the brand equity built over years, that's incredibly valuable in this business. It's very regional. They preserve that.
Ah, okay.
But then comes the build, or as I like to think of it, the supercharge part. They don't just leave them alone. They plug these businesses into Watsco's massive advantages. Access to capital. Remember that zero-debt balance sheet we'll get to. Access to their scalable technology platforms, which are way beyond what a regional players could build. Access to better supplier relationships and pricing. And they instill their culture of innovation.
So they take a good local business and give it superpowers.
That's a great way to put it. They transform these solid regional players into more efficient, tech-savvy, growth-oriented operations. And think about it from the seller's perspective.
Yeah.
Especially for family-owned businesses looking for an exit. Watsco becomes a really attractive partner. Your legacy doesn't just disappear. Your brand might continue, your people are often kept on, and the business gets turbocharged. It creates a sustainable pipeline of deals for Watsco.
That's a powerful model. Not just buying, but genuinely empowering and building upon what's already there. It's like a strategic partnership almost. No wonder it's fueled such a huge network. And speaking of that network, let's talk scale. What does this buy and build strategy actually look like on the ground? What's the footprint?
The scale is just immense, unmatched in this industry. As of Q2 2025, they are operating from 701 locations.
701. Wow.
And that was up from 690 just 6 months earlier, so they're still expanding. This isn't just national either. It spans 43 U.S. states, plus Canada, Mexico, Puerto Rico, and they even export to Latin America and the Caribbean. It's a vast reach.
But it's not just about being everywhere, right? There's a strategy to where they are dense.
Absolutely. It's very strategic. They have a huge focus on density in the Sun Belt. Think about it. Florida has 102 Watsco locations. Texas has 88.
Why the Sun Belt specifically?
Several reasons. Strong population growth, obviously, a massive existing base of older HVAC systems needing replacement, and crucially, year-round reliance on air conditioning. That constant use shortens equipment life cycles.
Creating more replacement demand.
Exactly. It creates this sort of durable tailwind for their business in those regions. And this density, this hyperlocal presence, gives them a critical last-mile logistical advantage. Meaning, when a contractor needs a specific part, like right now, to get a customer's AC back online.
Which happens all the time.
All the time. Watsco's local branch likely has it in stock, just miles away.
Yeah.
They can get it to the contractor incredibly quickly. That speed and reliability builds huge loyalty.
That immediate availability must be a massive edge, especially for urgent repairs. But it's not just their own locations, right? They have some really significant partnerships. I'm thinking about the joint ventures with Carrier. How big a deal are those?
No, they're fundamental, absolutely foundational to Watsco's market position. These aren't just casual handshake deals. We're talking multiple JVs, Carrier Enterprise 4, 1, 3, and Tech.
And what do these JVs do?
They grant Watsco exclusive distribution rights for Carrier's whole portfolio, Carrier, Bryant, Payne brands, in critical, high-volume territories.
Like where?
Like the entire U.S. Sunbelt, a big chunk of the Northeast, all of Mexico and Canada, massive markets.
Exclusive rights. What does that mean in terms of revenue?
Get this. In fiscal year 2024, these joint ventures alone accounted for 54% of Watsco's total revenues.
54%. Over half their business.
Over half. So connecting this to the bigger picture, this deep, symbiotic, exclusive relationship creates an incredibly powerful barrier to entry.
How so?
It makes it extremely difficult for any competitor to challenge Watsco's distribution dominance or Carrier's brand presence within these key markets. They've locked it up together. It's mutually beneficial and fortress-like.
So you've got this huge network, the Sunbelt focus, these massive exclusive partnerships. Where does that leave Watsco in the overall North American HVACR distribution market? Are they basically it? Or is there still room to grow?
Well, despite being the clear leader, what's fascinating is how much runway there still is.
Yeah.
This market is huge and remains surprisingly fragmented.
How big are we talking?
The North American wholesale market was estimated around $65.9 billion in 2024. And it's expected to grow at over 6% a year through 2030. Within the U.S. alone, it's maybe $64 to $74 billion annually. And get this, there are still somewhere between 2,100 and 2,200 distinct distribution companies out there. It's not consolidated at all.
2,000 companies. Wow. So where does Watsco fit in share-wise?
With their $7.6 billion in 2024 revenue, their North American market share is estimated somewhere around 10 to 12%. Some company estimates push it higher, maybe 18–20%, depending on exactly how you slice the market.
Only 10–12%, even as the leader.
Yeah, which raises that important question, right? How can the market be so fragmented and still offer so much growth potential for the leader?
So how do they keep growing in that environment?
It goes back to that buy and build strategy. It's perfectly suited for this fragmented landscape. They can keep acquiring strong regional players, benefiting from their local expertise, and then plugging them into Watsco's superior tech and capital base. They don't have to fight hundreds of tiny competitors head-on. They can partner with the best ones.
Okay, so Watsco's built this incredibly strong business model, smart acquisitions, key partnerships. But what about the industry itself? Are there bigger forces, these secular tailwinds, pushing the whole HVACR sector forward and benefiting Watsco?
Oh, absolutely. This is where you see the long-term power of the market they're in. There are several really strong growth drivers.
Yeah.
The biggest one, like we touched on, is the non-discretionary replacement cycle.
Right, things breaking down.
Exactly. The U.S. has this enormous installed base, over 120 million HVAC units. And something like 92 million of those are already over 10 years old.
92 million.
Yeah. Given a typical lifespan of maybe 8 to 20 years, a huge chunk of that base is constantly aging out.
Yeah.
That guarantees a steady, not optional stream of replacement demand.
Got it. What else?
Then there's the huge trend of energy efficiency and electrification.
Mhm.
This isn't just a short-term thing. It's a structural shift happening over decades.
Never by.
Consumers wanting lower energy bills, stricter government efficiency standards kicking in, utility rebates encouraging upgrades. It all pushes people towards better tech.
Like heat pumps.
Heat pumps are a perfect example. They do both heating and cooling super efficiently. They usually sell at higher prices too. Watsco saw, I think, 25% sales growth in heat pumps back in 2022, way faster than regular equipment, and shows the market shifting.
And regulations play a big role too, right? Not just suggestions, but mandates.
Huge role. They act as real game changers, often driving demand regardless of the economy. We saw new minimum efficiency standards in 2023, for instance, that forced older, less efficient models off the market.
But the really big one coming up is this A2L refrigerant transition starting in 2025. That sounds complex. What is it and why is it such a big deal?
It is the most impactful near-term regulatory shift, no question. It's a federally mandated phase down of the current refrigerants, HFCs, which have high global warming potential.
Okay.
They're being replaced by new, lower GWP refrigerants called A2Ls. Now, historically, these kinds of big refrigerant transitions, they act as powerful accelerators for replacement. Well, they can make the older equipment using the old refrigerant basically obsolete. It becomes harder, more expensive, sometimes impossible to service them. So replacing the whole system with a new A2L compliant one often becomes the most practical, even necessary choice. And one more tailwind, indoor air quality, or IAQ. Post-pandemic, people are just way more aware of the air they breathe indoors.
Right. Filters, purifiers.
Exactly. Increased demand for high-efficiency filtration, better ventilation, air purification systems. It's another growing category Watsco supplies.
So if you connect all this, the efficiency push, the A2L transition, IAQ, it sounds like systems are getting more complex. Does that complexity actually help a big player like Watsco?
It absolutely does. Think about it. Managing dual inventories for A2L, training thousands of employees and contractors on new safety protocols, handling compliance.
Yeah.
It takes significant resources.
Resources smaller distributors might not have.
Precisely. Watsco's scale, their financial strength, their tech platforms, they can handle this complexity much more effectively than smaller competitors. They can actually turn these regulatory challenges into opportunities to gain market share.
Okay, powerful tailwinds. But it can't all be smooth sailing. What about emerging trends or potential headwinds? Challenges on the horizon?
Well, on the opportunity side, you've got smart technology integration. We're seeing more IoT-enabled HVAC systems, remote monitoring, predictive maintenance, smart home tie-ins.
Higher value systems?
Potentially, yes.
Yeah.
Offers chances for better products, better service contracts. That's an upside. On the challenge side, a big one is the skilled labor shortage. Across all the trades, finding qualified HVAC technicians is tough.
Right, that could limit how many systems get installed or serviced.
It could constrain capacity,
Yeah.
But what's fascinating here, this challenge actually pushes contractors towards solutions that make their existing techs more efficient.
Like Watsco's digital tools.
Exactly. Those tools are designed to save technicians time, make them more productive. So Watsco helps solve a critical pain point for their customers, which builds loyalty. They turn a headwind into an advantage.
Clever. Any other challenges?
The usual suspects, really. Supply chain and cost volatility. Even though things are better than peak pandemic, disruptions can still happen. Commodity costs like copper and steel fluctuate. Watsco's scale helps them manage, but it's always a risk.
So let's pivot to that technology advantage. We've talked scale, network, partnerships. But how is Watsco not just a traditional box mover, but a real tech leader in this, arguably old economy industry? This digital moat seems key.
It absolutely is key. Watsco themselves say technology is a primary driver of organic growth and customer retention. They're not just adding tech, they're embedding it. They've invested heavily in a suite of proprietary digital tools that are miles ahead of most distributors.
Like what specifically?
Their e-commerce platforms and mobile apps are incredibly sophisticated. They're integrated right into how contractors work. Real-time inventory checks across all 700-plus locations.
Yeah.
Instant access to tech specs on your phone at the job site.
Yep.
24/7 ordering, account management. It's all there.
Is it getting traction? Are contractors actually using it?
Big time. In 2024, they did $2.6 billion in e-commerce sales.
Yeah.
That's 35% of their total annual sales.
35%. Wow.
Yeah, and they have over 64,000 authenticated mobile app users. But here's the kicker, the stickiness factor.
Yeah.
Customers who actively use these digital tools, they show about 60% less attrition.
Yeah.
Stick with Watsco. And they tend to place larger orders too.
So it really creates lock-in, a digital moat.
Exactly. Once a contractor relies on these tools for efficiency, it's really hard to switch away. Significant switching costs.
Okay, that's impressive. But let's zoom in on one specific tool you mentioned, On-Call Air. How does that change things for the contractor selling to a homeowner?
On-Call Air is brilliant. It's Watsco moving beyond just supplying stuff to actively helping their customers sell better. It's a digital sales platform for contractors.
What does it do?
It lets the contractor generate professional-looking, multi-option proposals, good, better, best for the homeowner, right there on a tablet in minutes.
Instead of scribbling on a notepad?
Exactly. It streamlines the whole sales process, makes it transparent. It even integrates financing options through their On-Call Air Finance Plus platform, making it easier for homeowners to say yes to a better, maybe higher efficiency system.
So it helps contractors sell more, maybe higher margin systems?
Precisely. It empowers them. And the numbers show it works. In 2024, On-Call Air was used to generate $1.2 billion in quotes for contractors. That was up 22% from the year before.
$1 billion in quotes.
Yeah. So what's fascinating is Watsco is directly improving their customers' business performance. That builds incredible loyalty. It's a win-win.
And behind all these slick apps and platforms, there must be a mountain of data, right? How do they manage all the product information?
That's where their Product Information Management System, or PIM, comes in. It's the unseen engine powering everything.
Okay.
Watsco has built arguably the industry's biggest, most comprehensive database of digitized product info. They've cataloged over 930,000 unique SKUs.
900,000.
Yeah. And it's not just a list. It's detailed specs, cross-references, manuals, pricing, everything. This rich, structured data is what makes their e-commerce search work so well, what feeds the mobile apps, what powers their system matching tools. It enables all that efficiency.
It sounds like a massive internal asset. How does this whole tech ecosystem compare to what the big manufacturers, the OEMs, might offer directly to contractors?
That's a crucial difference, and it highlights Watsco's moat. Sure, some OEMs have their own apps or portals, but they're naturally brand-specific.
Right.
A carrier app only helps with carrier products.
Exactly. But most contractors work with multiple brands. They install Carrier one day, Rheem the next, maybe Daikin, plus hundreds of different parts suppliers. Watsco's platforms are brand agnostic. They work across everything Watsco sells. So one platform for everything, regardless of brand.
Precisely. It offers contractors a much more practical, comprehensive, integrated solution. One ecosystem instead of 5 different apps. That makes Watsco's tech far stickier and more valuable day-to-day than any single OEM's offering could be. It reinforces their role as the essential hub.
Okay, strategy sounds brilliant, tech sounds amazing, but, the proof is in the pudding. How do the financial numbers look? Watsco's known for revenue growth, but what about profitability, especially with all these big investments they're making?
Right, profitability tells a more nuanced story lately. They did hit record revenues in 2024, $7.6 billion, up 4.6% from 2023. That came from both organic growth, same-store sales, and acquisitions. So top line is still growing.
Right.
But we have seen some gross margin compression. It slipped from a peak of maybe 27.9% in 2022 down to 26.8% in 2024.
Why the slip?
Mainly 2 things. A less favorable sales mix, meaning more lower-margin equipment versus higher-margin parts, and maybe less beneficial pricing actions for their OEM suppliers during that period.
Okay, so gross margin down a bit. What about operating and net margins?
Similar story. Operating margin contracted from 11.4% in 2022 to 10.3% in 2024. Net margin went from 8.3% down to 7.0%.
And what's driving that? Just the gross margin pressure?
That's part of it, but also increased SG&A selling, general and administrative expenses. Those costs have gone up quite a bit.
Why?
Because of those deliberate strategic investments we've been talking about. Spending on the tech platforms, expanding the network, and importantly, the significant costs tied to preparing for and managing the A2L refrigerant transition. It's an investment phase.
So they're spending money now for future gain.
That seems to be the story. Interestingly, in the most recent quarter, Q2 2025, revenue actually dipped 4% year over year because unit volumes were lower, but their gross margin hit a record 29.3%.
Wait, revenue down but gross margin up? How?
Good timing on some big OEM price increases, plus their pricing optimization tech really starting to pay off.
Oh.
SG&A still rose 6% in that same quarter. So a lot of that gross profit gain got eaten up by higher operating costs.
So the takeaway is,
The takeaway, connecting it to the bigger picture, is that these margin pressures and higher SG&A aren't necessarily weakness. They look like direct results of strategic choices, investing heavily now to strengthen their long-term position, gain share through A2L, and build that digital moat. Short-term pain for long-term gain, potentially.
it takes conviction to spend through a slowdown like that. But let's talk about something really stand out in their financials. The balance sheet. It's always called a fortress. What does that actually mean for them?
Fortress is the perfect word. It's exceptionally strong, very conservatively managed. As of mid-2025, they had around $293 million in cash. And here's the kicker. Zero debt.
Zero, like none.
Zero long-term debt. The shareholders' equity over $3.2 billion. This pristine condition gives them immense strategic flexibility.
How so? What can they do?
They can fund big acquisitions without blinking. They can invest aggressively in tech. They can expand the network. They can weather any economic downturn or industry shock without worrying about debt payments or covenants.
That's a huge advantage over leveraged competitors.
Massive, especially in a capital-intensive business like distribution that has cyclical elements. It gives them incredible optionality. Plus, the business itself throws off a lot of cash from Mugen. They reported record operating cash flow of $773 million in 2024. That cash fuels the growth and the dividend.
Okay, zero debt is amazing. But I did hear they've had some challenges managing working capital, inventory specifically, especially with A2L coming.
Yes, there's definitely an area management has flagged for improvement. Optimizing inventory turns is a big focus. And the A2L transition has made it way more complicated.
Oh.
They basically have to carry double inventory for a while, the old R410A systems and the new A2L stuff, to ensure a smooth transition for contractors.
That sounds expensive.
It is. That dual stocking, plus other factors, pushed their inventory levels up to $2 billion at one point. Management even said that was more than we had hoped for.
$2 billion in inventory.
Yeah. Plus, their business is seasonal. They always invest heavily in inventory in Q1 to prepare for the busy summer season. So, managing this complex inventory shift, efficiently balancing having enough stock without tying up too much cash, is a major operational focus right now.
Okay, so some near-term challenges on inventory. But despite that and the recent margin pressures, what's the long-term picture for shareholders? Have the returns been good?
All the long-term returns have been absolutely outstanding, legendary even. Over the last 35 years, Watsco's compounded annual total shareholder return, TSR, is 19%.
19% compounded for 35 years.
19%. That puts them in a very elite group of companies. It shows incredible, durable value creation. More recently, their return on equity, ROE, was a very healthy 16.96%. So yes, the strategy, the discipline, the balance sheet it has consistently translated into significant long-term value for shareholders. They're a true compounder.
Let's really drill down on that A2L refrigerant transition again. We flagged it as critical. It sounds like more than just an inconvenience. It's having a massive direct impact on Watsco's operations right now.
It is the defining issue for the industry at this moment, and Watsco is right in the thick of it. Remember, this transition impacts something like 50% to 60% of their product sales. It is hugely complex, it's expensive, and it touches every part of their business. Logistics, sales, training, inventory, everything.
What are the specific impacts?
Well, we mentioned the increased SG&A. That's driven largely by the need for massive training programs, not just for their own staff, but for tens of thousands of contractor customers on the new safety rules, handling procedures. A2L refrigerants are mildly flammable, so it's a big educational.
Well, yeah, safety first.
And then, as we just discussed, the huge inventory investment, carrying both the old R410A and the new A2L equipment simultaneously to ensure customers have what they need during the changeover. That's what pushed inventory to $2 billion. It's an enormous logistical and financial challenge.
Calling it a puzzle feels like an understatement. But, okay, huge near-term costs, major complexity. Is there a long-term upside here? An opportunity that makes navigating this crucible worthwhile, especially for a leader like Watsco?
Absolutely. And this is where their long-term strategic thinking shines. Despite the costs and headaches now, These big regulatory transitions have historically been powerful catalysts for market leaders.
How do they catalyze things?
They effectively make a big chunk of the existing installed HVAC base technologically obsolete, or at least much harder and more expensive to fix. As R410A refrigerant gets phased down and becomes scarce, servicing those older units gets tougher.
Pushing people towards full replacement.
Exactly. It accelerates the replacement cycle, driving demand for new, compliant A2L systems. And crucially, Watsco is making all these investments precisely to leverage its scale, its balance sheet, its tech platform to navigate this disruption better than smaller competitors can.
Do they plan to gain share through this?
That's the explicit goal. They're positioning themselves to come out stronger. It's a classic case of disruption benefiting the well-prepared, well-resourced leader who can invest through the chaos. They aim to be the go-to partner for contractors navigating this complex shift.
Okay, so A2L is massive. What other broader economic factors are playing a role in Watsco's world right now?
Well, inflation and pricing have been big factors. Rising costs for materials like copper and steel hit their input costs. OEMs passed along multiple price increases. Watsco has to manage passing those on effectively while protecting margins. It's a constant balancing act.
And interest rates. The housing market slowdown.
Yeah, interest rates and construction activity have had an impact. Higher rates cooled housing, so residential new construction R&C was down maybe 15–20%.
But that's a smaller part of their business, right?
Exactly. R&C is only 10–15% of sales. The huge replacement market buffers them significantly from that specific slowdown. Still, it's a headwind.
Is wide chain okay now?
Generally better, but still a risk. Especially when you're introducing whole new product lines like A2L equipment across 700 locations, it adds complexity. And finally, that dynamic we saw in Q2, lower unit volumes, combined with higher fixed costs like leases on all those locations that can cause negative operating deleverage.
Meaning profits get squeezed disproportionately when sales dip.
Right. A 4% sales decline led to a 6% SG&A increase in that example. So management's ability to really drive efficiency and control costs as things normalize post-A2L peak investment, that's going to be critical for profitability in the next few quarters.
So how does Watsco reward its owners for navigating all this? A big piece of the story is the dividend, right? They're known as a dividend darling.
They really are. It's a cornerstone of their shareholder return policy, and it shows huge confidence in their long-term cash flow. The track record is just amazing. They've paid dividends for 50 consecutive years.
50 years straight.
50 years, through thick and thin. That says a lot about the durability and cash generation of the business. And they're not just maintaining it, they're growing it aggressively.
How aggressive?
An 11% increase in 2023. Then another 10% hike in April 2024, bringing the annual rate to $10.80 a share. And then another 11% increase announced for April 2025, pushing it to $12 a share annually.
Wow, consistent double-digit growth.
Yeah. Now, this does result in a pretty high payout ratio, usually somewhere between 85% and 92% of earnings.
Meaning they pay out most of their profits as dividends.
They do. But that consistent, substantial growth, even while they're investing heavily in A2L and tech, it sends a powerful signal from management about their confidence in future earnings and cash flow.
Okay, dividends are clearly huge. What else are they doing with their capital? Still pursuing acquisitions as part of buy and build, reinvesting?
Absolutely. After the dividend, the main use of capital is fueling growth. The buy strategy is very much alive. That zero-debt balance sheet means they have the firepower for acquisitions of almost any size.
And they're still doing deals.
Oh, yeah. They bought Gateway Supply, Commercial Specialists, W.L. Lashley and Associates just in January 2025. So the M&A engine is humming. And alongside that, they're reinvesting heavily in organic growth, expanding the network, adding locations, and critically, pouring money into those tech platforms and the talent needed to keep innovating. Reinvestment is definitely a priority.
What about share buybacks? Is that part of the mix?
They have an authorization, yes, about 1.1 million shares remaining at the end of 2024. But practically speaking, they haven't really done broad open market buybacks since way back in 2008.
Really? Why not?
Any buybacks now are mostly just administrative, like covering taxes on employee stock awards. It shows a very clear preference. Management prioritizes direct investment in the business, M&A, tech, and direct returns via dividends over using cash for large-scale buybacks. It's a distinct philosophy.
Now let's talk leadership and governance. It's quite unique. You've got the founder, Albert Nahmad, still chairman and CEO since 1972. That's incredible tenure.
Almost unheard of. It provides amazing stability, consistent vision, deep industry knowledge.
Yeah.
And under him, they've built this very entrepreneurial, decentralized culture. Lots of focus on employee ownership, too, aligning interests.
But there's also this controlled company status. What does that mean for regular shareholders?
Right. That's a crucial piece. Under NYSE rules, Watsco is controlled because the Nomad family collectively holds over 50%, specifically 53.1% of the voting power.
How?
Through supervoting Class B stock. Each Class B share gets 10 votes, while the regular common stock gets only 1 vote per share.
So the family controls the board elections.
Essentially, yes. They can elect a majority of the board. This means public shareholders have a pretty limited ability to influence board composition or major strategic decisions, even if Watsco voluntarily follows most other governance standards. It's a key structural feature to be aware of.
And what's truly fascinating, maybe even radical, is how this structure connects to executive pay. I heard it's designed for extreme long-term focus.
It is absolutely distinctive, almost revolutionary for a public company today. And it's enabled by that controlled status. The key feature is their long-term equity incentives restricted stock for the CEO and president. It cliff vests only upon retirement.
Only at retirement, not over a few years.
Only at retirement, defined as age 62 or later. So get this. The current president, A.J. Nahmad, is 42. His stock awards won't even start vesting until he turns 62 in 2043.
20 years from now.
Roughly. Compare that to typical 3 to 5 year vesting. This structure creates this profound incentive for decision-making focused on building durable multi-decade value, not just hitting quarterly numbers.
And it keeps them there, presumably.
Oh yeah, it's a powerful retention tool. But you probably couldn't implement a plan like this in a company without that controlling shareholder structure. It really underscores their incredibly long-term, patient approach.
Okay, Watsco clearly presents a compelling case. Strong strategy, unique governance, long-term vision. How does the market value all of this? Does it trade at a premium?
Yes. Historically, Watsco trades at a significant premium valuation compared to peers and the broader market. Its forward PE ratio, for example, is around 29.
And how does that compare?
Well, other big distributors like WSO are maybe around 16.6, Core and Main around 25.8, so 29 is definitely higher. Same with price to sales. Watsco's PS is about 2.0, which is substantially higher than most distribution peers.
So what does that premium tell us?
It suggests investors are willing to pay up for what they perceive as higher quality. They're paying for this superior profitability, the focus on the attractive HVACR market, the industry-leading tech, that digital moat, and definitely that pristine zero-debt balance sheet. The market sees it as a premium asset, a long-term compounder.
And what about the dividend yield we discussed? How attractive is that compared to others?
It's definitely an attractive part of the story. With the $12 annual dividend coming in April 2025, the forward yield is around 3.04%.
How does that stack up?
Pretty well. Much better than many industrial peers like WSO, which is under 1%, and way better than OEM competitors like Carrier or Lennox, also typically below 1%. Plus, you have that strong history of 11% plus 5-year dividend growth. But investors do need to remember that high payout ratio, 85-92%.
Right. Balancing immediate yield with reinvestment potential.
Exactly. It's a deliberate choice they make, favoring direct returns, but it's something to factor in.
Okay. No investment is without risk. We have to balance the opportunity with caution. What are the key risks investors should be thinking about with Watsco?
Absolutely crucial to consider risks. The biggest operational one, arguably, is supplier concentration. Remember, 62% of their purchases are from Carrier and its affiliates, 85% from their top 10 suppliers.
So heavy reliance on a few key partners.
Extremely heavy. Any major disruption in the Carrier relationship, or if Carrier's products fell out of favor, that could seriously hurt Watsco's results. It's a symbiotic relationship, but concentration is a risk. Competition is always intense, from other big distributors, regional players, even OEMs trying to sell direct. There are also acquisition integration risks. M&A is core to their strategy, but deals can go wrong, integration can be messy, and of course seasonality and weather. Mild summers or winters definitely impact demand.
What about financial or market risks?
A deep economic downturn could still hurt, even with a non-discretionary base. People might defer replacements longer. New construction would suffer more. Standard enterprise risks like cybersecurity are always there. Data breaches, business interruption, and just general stock price volatility tied to results, market sentiment, analyst views.
And governance, that controlled structure.
Yes, the controlled company's status and concentrated voting power is a structural risk for public shareholders. The Nahmad family's 53% voting control limits the influence minority investors have on the board or key decisions.
So less safe for public shareholders.
Potentially, yes. It raises that question about influence and oversight, even if the company operates with high standards otherwise and fosters that long-term view. It's a unique structure that requires understanding. #tag Outra Tenbrick.
Okay, wow. We have really unpacked a lot today, a truly deep dive into Watsco Inc. It's clear this company is vital, incredibly resilient, and definitely a tech leader in this essential HVACR market. We've seen that unique buy and build strategy in action, the powerful digital moat they're deeping, that incredible fortress balance sheet, and that remarkably long-term vision. It's quite a
It
story.
really is. And we also have to acknowledge the complexities right now navigating that huge A2L transition, managing the margin pressures that come from investing so heavily, and dealing with the risks like supplier concentration and that unique governance structure. It's not simple.
No, definitely not. Watsco's story is this fascinating mix, isn't it? Old economy necessity, keeping the AC running, blended with really cutting-edge digital strategy. Quietly underpinning our comfort, but strategically very loud.
Absolutely. And ultimately, Watsco really demonstrates how focus, discipline in a niche fragmented market combined with smart, aggressive technology adoption, how that can create a truly powerful, enduring business that just compounds value over decades. So maybe a final thought for you to consider. As you look at critical infrastructure, essential services, what other unseen industries out there might be ripe for this kind of consolidation, this kind of tech transformation? Where might the next quiet giant be emerging?
That's a great question to ponder. Thank you for joining us on this deep dive today. We hope you found this exploration of Watsco as fascinating as we did.